Most people are trying to build wealth using tools they don't fully understand. Imagine trying to become a mechanic without understanding what an engine even is, or what it does. Or trying to play chess without knowing how the pieces move. That's exactly how many people approach investing. They buy stocks, they open TFSAs, they invest in ETFs, but they don't actually understand the language of investing. And that lack of understanding could lead to costly mistakes. The truth is, investing isn't complicated because investing is difficult. Investing feels complicated because nobody teaches us the language. So in this video, I'm going to break down the most important investing terms every investor should know in simple English so you can invest with more confidence, make smarter financial decisions, and better understand how money really works. Whether you're brand new to investing or looking to strengthen your financial knowledge, this video is for you. So let's get started. So let's start with the most important term of all, investing. Investing simply means putting your money into an asset with the goal of growing your wealth over time. Instead of letting your money sit idle in a bank account, you are putting it to work. So the example includes stocks, ETFs, real estate, businesses, bonds. So the goal is simple, to build wealth and create more financial opportunities for your future. Asset. An asset is something that has value and can potentially put money into your pocket. So think of assets as financial workers. Examples of this also include stocks, ETFs, real estate or rental properties, businesses, etc. Many wealthy people spend years accumulating assets because assets can continue producing income and growth long after they've been purchased. Liability. A liability is something that takes money out of your pocket. So examples of this include credit card debt, car loans, and personal loans. Whereas assets generally help build wealth. Liabilities generally reduce wealth. One of the biggest mindset shifts financially for successful people is focusing on acquiring more assets than liabilities. Net worth. Net worth is one of the most important financial measurements you can track. It's calculated by subtracting your liabilities from your assets. Let's say you own a home, investments, savings that are all worth $500,000, but then you owe $200,000 in debt. Your net worth would be $300,000. So that gives you a snapshot of your financial position today. Stock. A stock represents ownership in a company. When you buy a stock, you're purchasing a small piece of a business. If the company grows and becomes more valuable, your investment may increase in value as well. That's why many investors focus on owning quality companies long term. Share. A share is simply a unit of ownership in a company. When you buy a stock, you're buying shares. The more shares you own, the larger your ownership stake becomes. Shareholder. A shareholder is someone who owns shares in a company. So if you own a stock, you are officially a shareholder, which means that you're actually a part owner of that business. ETF. ETF stands for Exchange Traded Fund. So think of an ETF as a basket filled with investments. So instead of buying one company, you may own hundreds or even thousands of companies through a single ETF. This is one of the reasons why ETFs have become incredibly popular among long-term investors. Index fund. An index fund is a fund designed to track a market index. So examples of this includes S&P 500, TSX 60, NASDAQ 100, the list goes on. The goal isn't necessarily to beat the market. The goal is to match market performance. Diversification. Diversification means spreading your money across multiple investments. So instead of putting all your eggs into one basket, you spread risk across many assets. This helps reduce the impact of one poor performing investment. Dividend. A dividend is money paid by a company to shareholders. Some businesses share a portion of their profits with investors. This can create passive income simply by owning the investment. Dividend yield. Dividend yield tells you how much income an investment generates relative to its price. So put it simply, if a stock costs $100 and then pays $5 annually in dividends, its dividend yield is 5%. Compound growth. Compound growth is one of the most powerful concepts in investing. It's when your investments generate growth and then that growth starts generating additional growth. This is why time is often an investor's greatest asset. Compound interest. Compound interest is interest earning interest. So the longer money remains invested, the more powerful compounding becomes. It's often called the eighth wonder of the world for a reason. Dollar cost averaging. Dollar cost averaging means investing consistently over time. So what this looks like is daily investing, weekly, bi-weekly, or even monthly. So instead of trying to time the market, you invest regularly regardless of what the market is doing. Market capitalization. Market capitalization, often called market cap, measures the size of a company. So the formula of this is usually the share price times shares outstanding. Companies are generally categorized as small cap, mid cap, and even large cap. Bull market. Bull market is a period when stocks are generally rising. Investor confidence tends to be high during bull markets. Bear market. A bear market occurs when markets decline significantly, so typically by 20% or more. While uncomfortable, bear markets are a normal part of investing. Volatility. Volatility measures how much an investment price moves up or down. Higher volatility means larger swings, whereas lower volatility means more stability. TFSA. The tax-free savings account is one of the most powerful investing tools available to Canadians. Despite the name, it's not meant only for savings. A TFSA can hold stocks, ETFs, REITs, mutual funds, and GICs. Investment growth inside a TFSA is generally tax-free. RRSP. The Registered Retirement Savings Plan is designed to help Canadians save for retirement. One major advantage is that contributions may reduce your taxable income. Capital gain. A capital gain occurs when you sell an investment more than what you paid for it. For example, if you buy a stock at $100 and then you sell it at $150, your capital gain is $50. Passive income. Passive income is income earned without directly trading time for every dollar. Examples of this include dividends, rental income, and royalties. Cash flow. Cash flow is money coming in minus money going out. Positive cash flow is one of the foundations of wealth building. Last but not least, financial freedom. Financial freedom occurs when your investments and assets generate enough income to cover your lifestyle expenses. So at that point, work becomes a choice rather than a need. The truth is, investing isn't just about making money. It's about understanding how money works. The more fluent you become in the language of investing, the more confident and informed you'll become as an investor. And over time, that knowledge can actually help you make better decisions, avoid costly mistakes, and build long-term wealth. If you enjoyed this video, make sure to like, subscribe, and continue investing in your financial future, because the financial decisions you make today can completely change your financial future tomorrow.